All right, let's dive right in. Today we are looking at a claim that honestly sounds a little bit crazy. We're talking about a 200% annual yield on gold. Yeah, you heard that right, gold. So how on earth could a super stable, kind of boring asset pull off returns like that? Well, that's exactly what we're going to unpack. Just let that sink in for a second. 200%. I mean, we live in a world where if you get a 10% return in a year, you're feeling pretty fantastic, right? This number just seems to defy all logic. And look, this isn't some brand new, super volatile crypto coin we're talking about here. This is gold, the thing people run to for safety. So it begs the question, how is this even possible? That's what we're here to figure out. Okay, so here's our game plan. First, we're going to get into the engine behind all this, a little something called the delta neutral strategy. Then, we'll look at the actual trade itself. After that, and this is super important, we'll uncover the huge risk that comes with a yield this high. And finally, we'll see how this whole thing fits into a much bigger bet against precious metals in general.
So yeah, this isn't just some abstract theory. The source material for this is actually a case study from a trader who's actively running this strategy right now. It's a real-world experiment with real money on the line.
Let's get to the core of this whole operation, the delta neutral strategy. If you can wrap your head around this, you'll understand exactly how that 200% yield is supposedly being generated.
So, what in the world is delta neutral? Well, think of it like this. Imagine you could make a bet on a coin flip where you win the exact same amount of money whether it lands on heads or tails. That's kind of the core idea. You're setting up your trades in a way that just completely cancels out any price changes. So whether gold goes up or down, it literally doesn't matter to your portfolio's value. The profit then has to be coming from somewhere else entirely.
And this strategy has two parts, or two legs. First, you take a long position. You do this by putting your money into what's called a decentralized liquidity pool, or a CLP. Just think of it as a big pot of money that other people use for trading, and you get a little piece of their fees. At the exact same time, you take an equal-sized short position on another platform, in this case, GMX. This is basically a bet that the price will go down. And this short position earns its yield from something called a funding rate, which, trust me, is the key to this whole puzzle. And this is where the numbers just get wild. So that long position, it's earning a very respectable 70% just from trading fees. But the short position, oh man, that's where the magic is. It's pulling in somewhere between 130% and 200% from the funding rate alone. Now, funding rate is basically a fee that one side of a trade pays to the other just to keep prices balanced. And in this case, there are just so many people betting that gold will go up that they are paying a massive premium to anyone willing to take the other side of that bet. And that premium, that's where the profit is.
Okay, so that's the theory. Now let's see how the trader in our source material actually put all of this into practice.
Now, he didn't just dive in headfirst with a ton of money. Nope, he started out small, with just a couple $1,000. And the whole point was just to prove the concept, to make absolutely sure that his positions were truly delta neutral, that they really would cancel each other out no matter which way the price of gold went.
And once he proved it worked, he scaled it up. At the time of the recording, his total position was $4,200 on the long side and a perfectly matched $4,200 on the short side. So here's how the math breaks down. You take that solid 70% yield you're getting from the liquidity pool, and then you stack the incredible 132% yield from the funding rate right on top of it. And remember, neither of these depends on the price of gold itself. They're two totally separate streams of income that, when you put them together, create that unbelievable 200% yield.
Okay, but let's be real. A 200% yield, that doesn't happen without some serious risk. There is no such thing as a free lunch, right? So the most important part of this whole thing is figuring out, where's the catch?
And the catch is the very thing that's making all the money, the funding rate. See, this whole strategy only works because tons of traders are paying that big premium to bet long on gold. But market sentiment can change in a heartbeat, and there is absolutely zero guarantee that this rate is going to stay positive.
So look, on the one hand, you've got the perfect scenario where everything's working great. You earn your 70% from fees, and you collect another 132% from that positive funding rate. Awesome. But on the other hand, you have the total nightmare scenario. What if the market sentiment just flips on a dime and everyone starts betting short? Well, now that funding rate turns negative, and all of a sudden, you're the one paying out. If it flips to something crazy like negative 200%, your 70% gain is gone in a flash, and you are deep, deep in the red.
And the trader himself is totally upfront about this risk. He says it himself. If that funding rate went heavily negative and stayed there, it would completely wipe out his profits, and he'd have no choice but to close the whole position down just to stop the bleeding. This is the single biggest point of failure in this entire strategy.
So let's zoom out a bit. This delta-neutral trade, it doesn't just exist in a vacuum. It's actually part of this trader's much bigger view of the market, which is basically that he's pretty bearish on precious metals right now.
At the heart of it, this trader believes that the crazy, parabolic price moves we've seen in precious metals just can't last. He's looking at the charts and seeing signs of what he calls market exhaustion. Basically, the point where there are no new buyers left to keep pushing the price up. For him, a big correction isn't a question of if, but when.
He feels especially strong about silver. He comes right out and says that the top is probably in and that we may have just seen the highest price for silver for the next decade. I mean, that is a really bold call to make.
And he's got specific targets. He's looking for gold to correct back down to the $4,400 level. He sees silver falling back into the $50 to $55 range, and he thinks copper's recent move up was a false breakout that could send it tumbling down to $4.30.
So what's the big takeaway from all this? Well, the trader gives a really crucial piece of advice for managing risk. He says that in markets that are getting more and more volatile and uncertain, you shouldn't be increasing your bets, you should be shrinking them. The crazier the market gets, the smaller your position size should be.
So you can see, the trader is really skeptical of that whole "this time is different" story that you always hear when markets are flying high. He sees all the classic signs of a market that's about to top out. But, it does leave us with that one nagging question. What if? What if the bulls are right? What if this time really is different? And that right there is the multi-million-dollar question that absolutely everyone is trying to answer.